Hello, everyone. Thank you for making the choice to invest in yourself and your practice by joining today's CE accredited financial planning session, part 2 of our deep dive into the 2024 IAFP Symposium Case Study. May the wealth be with you. Throughout this hour, you will have to answer 3 poll questions in order to qualify for the applicable credit for today's session. After we're done, I'll be sending your poll responses directly to the IAFP team, and they will be distributing these certificates to everyone who answered all 3 questions correctly. Not to worry, the questions are not overly complex. As long as you are here and paying attention, I suspect you'll be just fine. In addition to the CE credits, we do have a special offer which will be shared at the end of the session. If you missed part 1, nothing to worry about there. That is available on YouTube, and I will be sending out the recordings to both of these sessions after. So my name is Alex Mercer, and I will be your host today. I'm joined by my colleague, Steve Arnott, Snap's Financial Planning Project Lead, who will provide today's demonstration and run the Q&A. For anyone who doesn't already have it, the Symposium Case Study is available for download under the Handouts tab. So if you click the arrow beside the word Handouts, you can open that up and the PDF is right there for you to grab. And I will also include it in the follow-up email. So before we get started, I'd like to do a quick tech check just to make sure you can all hear me and see my screen. Can you send me a quick yes or even a smiley face through your question tab? You should see it in your control panel, just the same as you would access that Handouts tab. Just click the arrow beside the word questions. Oh, perfect. I can see you guys are already ahead of me. Davis, Jeremiah, Mark, thank you so much for letting me know that you can see us and hear me and see the screen. So Steve and I have our cameras turned on just to say hello. We will now shut them off to give you a full screen view of our presentation. So, as I already said, today is part 2 of this series. Part 1 was about keeping things simple and creating the foundational knowledge for something more comprehensive. Today, we will build out the full case study for our clients, Luke Skywalker and Mara Jade. The theme of today is relationship management. How can we provide our clients who have complex planning needs with the peace of mind they require? Many of you here today already know us, but for those of you who do not, Snap Projections provides transparent, easy to use, and highly flexible financial planning software for Canadian planners and advisors. This product continues to be developed with advisors for advisors. Advisor input and involvement is how we continue to bring what you need to market. If you want to hear from other advisors who are already using Snap, you can find reviews numerous places online. For example, on Capterra, which is an independent third-party software review site, you will find advisors saying things like none of their clients retire without a Snap projection, and that the software has been foundational to their firm. As you can see, we are currently sitting at 4.9 out of 5 stars. We have been in market for 10 years, enthusiastically serving the thousands of financial advisors, planners, and investment managers who partner with Snap to grow their assets under management and increase quality referrals. We are trusted by major firms such as CI Asante, Aligned Capital Partners, PPI, Sterling Mutuals, and many more. And we are thrilled to share that Snap Projections financial planning software is now fully available in both French and English. In the dashboard, you can easily switch back and forth between both languages. So we have got a lot to cover this hour, so let's get to it. Today, we are going to work through how to provide clients with complex planning needs peace of mind. This is going to start with modeling their lives accurately. Now, this is possible because SNAP has the flexibility required to model even the most comprehensive cases. Again, please grab the case study from the Handouts tab if you have not done so already so you can follow along. I see we've had about 30 people hop in the last 1 or 2 minutes. Don't worry, you haven't missed anything crucial yet. We do have 3 questions that will have to be answered for your CE credit, and the first question is coming up in just a moment. So Luke and Mara have a lot going on. They're concerned about the volatility of their investment portfolio. Luke's workplace accident has disrupted their lives and forced them to deal with disability concerns. They'd like to provide financial assistance to a friend in need, and their aging parents are going to leave them with increased caregiving responsibilities. The list of things to worry about goes on. So how can we help them today? Before Steve takes over and logs into Snap to get started building out this complex case, let's get our first of 3 poll questions out of the way. You are going to see this pop up on your screen in just a second. Who are we discussing today? So your options are Luke's parents, excuse me. Number 2 is our clients, Luke Skywalker and Mara Jade. And your third option would be our client's child, Ben Skywalker. So I'll give you a few more seconds here. Nearly everyone has got their votes in. I'll give you about 5 more seconds. Almost everyone has got their votes in, and perfect. 5, 4, 3, 2, 1, and here we go. I am closing the poll. Wonderful. Thank you so much, everybody, for getting those answers in. And with that, I will hand it over to Steve for our in-software learning.
Perfect. Thank you, Alex, and thanks everyone again for joining us today. Snap Projections is a web-based platform, which means that you can access your account from any Chrome browser on any computer without the need for a download. You'll go to snapprojections.com, and then in the top right, click Login to enter your username, password, and the option for multi-factor authentication. I've done that during today's call, so I'll click Login and go directly into the software. I land initially on my clients page where I can access any of the projections I've created in the past, or I can get started on adding a new client. You'll see that we have the file for Ben Skywalker from our first session earlier in the summer. Today, I'm going to click Add New Client, and we'll get started creating a plan for Luke and Mara. So I'll input their first and last name, their date of birth, and their province of residence, which is currently Ontario. I'll enter in Mara's information, and then in the top left corner of the software, you'll see that there are 3 main sections to the tool. The first is the scenario setup. This is where we're able to enter in all of our base plan data. This is things like their expenses, incomes, assets, and debts. Once we've entered in the base information for the projection, we will then proceed to the planning pages where all of that information comes together to show Luke and Mara's life on one page. From here, we can review information, make changes on a year-to-year basis or for any period of time. And then once we're comfortable with all of the numbers, we can proceed to the client report in order to customize the charts, tables, and commentary included in the PDF document. For now, we'll continue on with the scenario setup. I'll click Next, and we'll go to our general plan settings. Because we're so far into calendar year 2024, I'm going to begin this projection as of January 1st, 2025. This allows us to assume that all balances entered in the plan, such as assets and debts, are the balance effective January 1st, 2025, and we won't have to worry about any final year values for the remainder of 2024. We're going to target a retirement age for Luke of 61 and Mara of 59, and we're going to run the projection until age 98 for each client. As I scroll down, you'll see that I've defaulted to the FP Canada guideline assumptions for inflation, and then I've reduced the default values for cash, fixed income, and equity by expected management fees to arrive at a net return assumption. On the expenses page, there's quite a few options available depending on what information you have on your client's situation. You can leave this page blank and have Snap help you to calculate appropriate expenses from the planning page, or if you have a budget that the client is currently targeting or spending, you can enter in that information here. So for Luke and Mara, we have a target annual budget of $100,000 net of tax, inflation adjusted over time. In our last scenario, we had also discussed that Luke and Mara are going to help Ben with a first home savings account funding. So they're going to be providing him with a gift of $8,000 a year. And that's going to run from Luke's age 57 until 61. So that will provide a total of $40,000 to Ben in order to fund the first home savings account towards the first home purchase that we modeled under his projection. So now this can show how you can model all sorts of different transactions and have those, very similar cash flows modeled in different clients' projections. So those are the expenses that we'll enter. I'll click next and go to incomes. Luke recently had a workplace accident where he lost his hand and he's currently on disability. So I'm going to update the description to disability income. He's currently receiving $60,000 per year, and that is other and taxable income. And that's expected to run until he turns 65. So we can enter in his age here, and then we have the ability to click on this black year symbol and enter in an exact date that it's expected to stop. So we'll set his birthday. He's also expecting an accidental death and dismemberment payout of $110,000. And that's just a one-time non-taxable cash flow. So we'll enter in his expected age, which is 56. So this is just going to happen in the first year of the projection in 2025, and it's just going to happen for 1 year of the plan. In the top left, I can click on Mara's name in order to go and adjust her income information. So here we have employment income of 120,000. We'll assume that that gets indexed with the general inflation rate in the plan. It's employment income, so Snap will deduct CPP and EI automatically. It will tax it, track RSP room, and then run that until the end of the year prior to her target retirement. Clicking next, we can go to the assets page. And again, I can start with Luke or Mara. In this case, I'll go to Luke's assets page to start entering in his account balances. He has a checking account of 120,000. And you'll see that by default, Snap has pre-populated the rate of return values for cash, fixed income, and equity from our general settings. We can customize these on an account by account basis. So for instance, if there's no interest currently being earned on this cash, I can change the rate of return on a one-off account basis. He also has a savings account set up that doesn't currently have any balance. That's 100% cash with a low interest rate. He has a joint account with Mara that has $8,000. He also has a federal locked-in account with $35,000. And that's currently invested in a mix of cash, fixed income, and equity. So you'll see Snap again takes the rate of return values from our general page and then calculates a blended portfolio return. He also has a Saskatchewan lira with 160,000. An Alberta lira with 85,000. There's a spousal RRSP that has 480,000. And finally, a tax-free savings account with $130,000. Now that we've entered in the accounts, you'll see across the top of the table, there are tabs for each of the different registered account types where we can customize further settings as needed. And this is a common theme throughout Snap, where you can create quick and simple projections using default conservative assumptions, or you can go through the settings and assumptions tables in order to customize values to reflect your client's unique circumstances. So if we go to the TFSA, you'll see that right now, the assumption is that there will only be the new contribution room starting next year available. If Luke had carry forward room from previous years, we could enter that here. Similar for RSPs, there's a default assumption based off of the salary that was entered within the plan. Because Luke has not historically been contributing to the account, he has $150,000 of carry forward that we could use in the plan. On the DCP Lira Lift tab, you'll see that we can set the jurisdiction for each of the accounts. So I'll set this first one to federal, then Saskatchewan, and then Alberta. And this is going to help Snap to track the maximum withdrawal rules, as well as to govern the unlocking rules within the software. So by putting those in place, you create the guardrails that will assist you in quickly modeling different client circumstances. Now that we've entered in all of the accounts for Luke, we can click on Mara's name and do the same there. And sorry, I just realized that for the joint savings account, I'll want that joint column to be yes. And that way the balance and the account information will show on each of their assets page. So now for Mara, we have the joint account. I'll repurpose this default non-reg into her checking account, which has $7,000. And that's not currently earning interest. She also has savings of $15,000. And some shares from a previous inheritance. So $150,000 all in equities. So we'll put that as 0, 0, and 100% equity. And again, you can see the rate of return is adjusted based off the asset allocation. Mara also has an IPP, which we're going to model in the projection as an RRSP so that the future withdrawals are considered taxable income. We have a tax-free savings account with $125,000. And then similar, we can go across the top, click on TFSA. There's no additional carry forward, so we'll leave it as 7. It's already calculated 18% of her current salary. And because Mara has been maxing out the spousal RSP, we're gonna leave that value in this case. So we're all set from a registered account settings. Go back to the assets page and scroll down to the real assets section so that we can input their current home value. So their property is worth 2 million, original cost of 1 million. You can set any custom appreciation rate that you would like. You can enter in future purchase age if they're saving up for a home or a second property. You can enter in a future sale age if you'd like to show downsizing or upsizing, which we will do shortly. Set the asset as joint, and then indicate whether there are any capital gains taxes applicable to the sale. I'll click next and go to debts, where we can enter in their line of credit of 15,000. Now this is a loan that they took out at an interest rate of 7%, but their friend Han is currently covering the interest payments. So in the model, I'm going to set it as 0% interest rate. If you'd like to be more conservative in case Han stops making those interest payments, you could enter in the 7% and assume that they may have to cover that in the future. I'll click next and go to the government benefits page. From here, we can customize the start age and the dollar value or the percentage of maximum. So in our base scenario, we're going to start with an assumed CPP start age of 65. You'll see that by default, SNAP assumes that the client will receive the national average CPP benefit, which is 55% of the maximum. In this case, I'm going to assume that Mara will receive closer to 75% based off of her previous employment income and her target retirement age. If the client was already receiving CPP or they had a Service Canada statement that projected how much they should receive, you can enter in the dollar value directly. Similar settings available for old age security. So we're going to start at 65 with an assumed value of 100% of the maximum. For Luke, we'll set the start age to 65, and then because of his disability and some previous work outages, we're going to assume that he will receive closer to 70% of the maximum. I'll click next and go to the insurance page where we can enter in both of their term policies. So there's a term for Luke, and that currently runs until age 61 with a death benefit of $400,000 and an annual premium of $300. And then there's a similar policy in place for Mara, going until age 59 for $400,000 with a premium of $250 a year. I'll click next and go to the RESP, and I can add in the account that they're still using for supporting Ben with his last few years of college. There's a current balance of $50,000. We can enter in Ben's information. So he was born in 2004. He has received $5,000 of total CESG, and we're going to be providing $7,500 of ongoing annual support out of the RESP. Now, we started doing that when Ben turned 19, and we plan to do that for 4 years. So 2 of those years have already passed, and we're just going to do 2 more withdrawals out of the remaining balance. So I'll click Save. And then on the left, we have a few final pages available. Similar to the registered account tabs on the assets page, there are additional settings that you can customize as needed to really tailor the plan for unique client circumstances. So the first is the portfolio settings. This is what determines the non-registered investment income within the plan, whether that's made up of interest income, dividends, capital gains, and how much of each of those. You can customize those settings here. You can also customize what happens if there's any surplus or shortfall cash balances within the plan. And then within the income taxes, we have quite a few standard tax credits already factored into the projection, while providing you the option to enter in additional either non-refundable tax credits or tax deductions or benefits. Now in this case, with Luke's name selected in the top left, we're going to enter in the information for the disability tax credit out of Ontario. So we'll enter federal and then provincial disability tax credits. That will be added on top of all of the other personal numbers. We can enable charitable donations if those are a material component of the client's cash flow, and add corporations. But for this case, we're all set with the scenario setup pages. I'll click planning pages and we'll see how all of this data can come together to show us Luke and Mara's life on one page. Now, the planning pages can seem overwhelming when you first see them, but once you know what you're looking at, it's incredibly intuitive and a very powerful section of the software. On the left is the year and our client's age. Then the software has calculated the discretionary leftover cash flow based off of all of the inputs in the plan so far. So this is taking the employment income for Mara, the disability income, and the accidental death and dismemberment payout. It's subtracting off the taxes payable, subtracting off any debt or premium payments, and then assuming that the rest is available for cash flow needs. We have 2 options available for what to do with this spending amount. We can either manually contribute any surplus that we expect the client to have into their financial assets. So we could, for instance, enter a $100,000 deposit to the non-registered account or top up their TFSAs. Or we can turn on the cash flow management right from the first year of the projection. So as a conservative default, SNAP begins the target budget at retirement, but just by clicking on the start age in the first year of the plan, and then clicking on the red run button in the top right corner to apply that change to the software, we can set a target budget of 100,000 and have SNAP automatically contribute the surplus money into the financial assets. So you'll see it's maxing out the TFSA based off of the contribution room available. It's maxing out the RSP, and then there's some contributions into non-registered accounts. We can also control any of those deposits manually by going to the individual planning pages. So if I click on Luke's name, for instance, if I want any RSP contributions going into the spousal RSP, I can just scroll to that account, enter in the maximum of 21,600, copy that down and index it. And now that I've entered in that contribution, when I run the scenario, Snap is going to make sure that that specific contribution is occurring out of the cash flow that's available. So Snap can automatically move money, and then you can override and request specific deposits or withdrawals as needed. So now that we've modeled all of their financial assets, their debts, their real assets, we can get a sense of whether they're on track for their target goal. So again, in the first year, they're spending 100,000 now. Any surplus cash flow is being automatically allocated to financial assets. We can see 150,000 in the first year, that's related to the insurance payout, and then 36,000 roughly for the next 4 years prior to retirement. Then once they hit retirement at age 100, we can see that the employment income drops off. There's still a little bit of disability income until Luke turns 65. And then there are government benefits such as CPP and OAS that kick in. And you'll see that a lot of information is available right from the combined planning page. If you want to expand any of these sections to learn more, you can break them out into additional columns to really dig into the numbers and what's happening. Then you can collapse that section, move on to the next. For instance, with benefits, we can see a combination of CPP, OAS, and then eventually CPP survivor benefit once the first spouse passes away. So continuing in retirement, we have the target spending, a bit of income, and then Snap is automatically withdrawing on a tax-efficient basis out of the financial assets in order to top up the client's cash flow and reach their target spending goal. And we can see those withdrawals continuing all the way throughout retirement. Once the RIF minimum kicks in, it's actually more money than they need for spending. And so we get a bit of a TFSA top-up occurring. And by the end of the projection in 2069, when Mara turns 98, there's still a buffer of $3 million left over in financial assets, in addition to the value of their home. So they have a fairly large buffer based off of their current life circumstances. Now, as we saw at the beginning, there are quite a few moving parts and challenges that they're looking to navigate. So things will change from here, but in terms of our base scenario with just their default data, things are looking generally positive. We can also review this projection in the form of charts. So if I click on charts at the top, I can see where the client's money is going each and every year, whether that's their 100,000 indexed spending goal, their first home savings gift going to Ben, income taxes, insurance premiums, or contributions into their financial assets. I can see where the money is coming from. And then I can see how much is available across each different type of asset or debt. And we can interact with any of these charts by clicking on the legend items to create custom views. So just like that, in about 20 minutes, we've been able to input all of our scenario setup data, review the planning pages, make a few customizations, and be comfortable with the base level of understanding of where Luke and Mara are at today. Let's go back to their list of challenges to better understand how we can help them navigate this now that we have a base projection created. Some of the challenges that Luke and Mara are facing are things like concerns about the volatility of their investment portfolio. They've built up several $1 million across all of their investments, and they're concerned about whether that's going to be enough for them throughout retirement, what will happen if there's a down market year. So we can have a conversation with them about the risk to their portfolio and what they can do to help mitigate those concerns. Similarly, Luke has recently gone through a life-changing experience with losing his hand. It's impacted his ability to work. It's impacted his ability to service their rural home. So lots of conversations that we can have related to that. They're feeling pressured to further help their friend Han Solo financially, and they have aging parents who are in more and more need of caregiving support. So for all of these, we can create additional projections, do some changes to the assumptions in order to illustrate to Luke and Mara what options they have available and what the best choice may be given their goals and priorities in their lives. So I'm going to start by creating a copy of this plan. So I go to the top of the planning page, click on the white menu buttons, and then click Copy Scenario. And the first plan that we're going to create is Scenario 2, which is to move closer to Anakin. And this would serve two purposes. One is that Luke and Mara currently live in a rural setting with a large property, and Luke's concerned that he won't be able to continue to service that over time with his with his missing hand. In addition to that, Anakin, his father, is getting older and may need additional support that they would be able to provide if they lived closer. The biggest challenge here is that the property values are quite substantially different. So their current property is worth $2 million. In order to move close enough to Anakin for it to make sense, they would need to spend about $3 million on a similar property. So we can model those transactions in the plan and see whether that's feasible given their current circumstances. So I'll start by going to Scenario Setup and then Assets. And I'll scroll down to the Real Assets section where we have their current home. And we're going to enter in a future sale age. And we're going to do this as of the start of 2026. So I can enter in a direct date. And then we're going to buy a new home for $3 million at the same time. So I'll enter in a future purchase age of 2026. And that will be a joint property as well. So we've entered in the sale assumption, the purchase assumption. And now in terms of funding the $1 million gap, we know that they have about $250,000 in available liquid cash, and that's a combination of current checking savings and the expected insurance payout starting next year. So we're going to use that cash in addition to a new mortgage of $750,000 to finance their additional payment. So I'll go to debts and enter in a new mortgage. That'll be $750,000, interest rate of 5%. We'll set a future start age at the same time, so we'll receive that cash in 2026. And the monthly payments would need to be roughly $43.62 in order to maintain a reasonable amortization period. And we can link that to the new home so that if we sell the new home at any time in the plan, if the new mortgage is still outstanding, then Snap would repay any outstanding balance. So now that we've entered in the asset changes and the new debt, we can go to the planning page to see how this would impact their financial future. So if we scroll all the way to the right in the year 2026, we can see the transactions taking place. So, and sorry, I'll want to do that from the combined page. So I'll click on combined at the top left, scroll all the way to the right, and we can see these transactions taking place in the software. So we see the value of the real asset increasing from 2 million to 3. We can see the debt increasing from the 15,000 line of credit up to the line of credit plus the home mortgage. We can see Snap withdrawing about 250,000 automatically out of the non-registered asset balances. And then we can also see going forward that there's an additional mortgage payment on an annual basis of $52,344. And this cash flow is in addition to the 100,000 annual spending need that they'll still have. So now what we'll see is that Snap is going to very quickly need to withdraw from those accounts. And as a result of the increased cost of the mortgage, we can see that they run out of money as of age 83 and 81. So all of their RSP, TFSA, and non-reg account balances have been depleted, and they would have no cash flow available other than government benefits at that point of the plan. However, they would have a very valuable property that they could either borrow against or downsize. So the next illustration that we're going to show is what their cash flow would look like if they were to downsize later on, potentially once Anakin has passed away and once their lifestyle has changed and they may be able to make do with something a bit smaller. So we'll go back up to the menu option again, click Copy Scenario, and then we'll create our third scenario for Luke and Mara. So we'll call this scenario 3, move closer to Anakin and downsize at age 80. So all I have to do in this case is go to scenario setup, go back to the assets page, and then in the future sale age for the new home, we're going to enter in age 80, and that'll occur in 2049. And then we're going to enter in a downsized home that they'll purchase for $3 million at that time in the plan. So as a note, the cost that you enter on this input page is the nominal future dollar value in the year of the transaction. So they're going to sell this property for closer to $4.5 million, just based off of the 2% appreciation rate. And then we're going to use $3 million out of that proceeds to buy a replacement property. And we'll do that at age 80 as well. So now that we've modeled those two transactions, we'll go back to the planning page and take a look at the results. So going to the combined page, we'll then scroll down to age 80. Oh, I must not have made it, sorry. We want that new downsized home to be joint as well. So that way the cash flow is being split appropriately and neither of them are running into any issues paying for their portion of the transaction. So now that we've modeled the joint downsizing at age 80 in 2049, we can see that Snap is selling for about 4.8 million, buying for 3 million, netting 1.8 million, and then investing that across the financial assets based off of contribution limits. So it takes care of all of this automatic cash flow management. You do still maintain the ability to change any of those values, but Snap is creating a starting point that is efficient for modeling purposes. Then they are able to use that replenished account balance to continue to spend throughout retirement, and then they have a buffer of about $1 million at the end of the plan. So it does look like moving closer to Anakin would work for the foreseeable future, and then they need to plan for a downsizing to unlock some equity for later spending in retirement. Now, both of these options are exploring moving. Another option that they'd like to consider is maintaining their current property with the knowledge that they will need to pay more money for someone to help out on the property with things like snow removal, maintenance of the house, things of that nature. So we're going to go back to our original base scenario, and we're going to copy that plan and then add in an additional expense instead of adding in the new home purchase. So here we'll call this scenario 4, stay in current home and pay for additional support. And then we'll go to scenario setup, go to the expenses page and add in a new expense, rural property support of $12,000 a year, indexed for inflation, and we'll run that from the first year to the last year of the projection. So now on the planning page, we can see whether that's feasible for them to be able to support additional spending of $1,000 a month for those additional supports. So now we have the extra expense. And as we continue down throughout retirement, we can see that they're left with about $1 million between the TFSA and RSP. So it's similar to the downsizing situation, but they'll have more flexibility in terms of their overall cash flows. So now that we've created these 4 scenarios, in order to help Mara and Luke to make decisions about what is in their best interest, we can use the scenario comparison tool to have a conversation about differences in outcomes and what will be best for their various goals. So I'm going to click on the menu at the top and then click Compare Scenario. I'm going to select all 4 to start with. And now we have our scenario comparison. We'll start with the summary, which is a table with each of our scenarios as a column. So scenario 1, 2, 3, and 4. And then a bunch of key metrics that will help us to understand the differences in outcomes. So a very quick reference point that we can use is the goal progress. This is how much of the client's base spending is funded through liquid resources such as financial assets. So how much of their base spending are they able to cover in the projection? In this case, it's 130%. If they move closer without downsizing, they'd run out of money about 2/3 of the way through retirement. If they downsize, then they're back on track with a bit of a buffer. And similarly, if they were to just add in the additional expense and stay in place, they would have a similar level of coverage for their spending needs. In addition to the goal progress, we have lots of great information about lifetime expenses, lifetime taxes. We can see how much they're expected to receive in government benefits and whether there's any OAS clawback. And then one of the most common reference points to compare is the estate after tax. This is a value that kind of factors everything that you've modeled into a single variable. While it is not as relevant for people that are worried about longevity, it can still be thought of as the available money that they would have for personal spending needs, net of any debt or tax liabilities. So we can see they had a very large buffer without the additional lifestyle changes. And then in any of the three scenarios where they're moving or needing to add in additional expenses, it impacts their projected estate quite substantially. And you can customize what metrics are included in the table. So for instance, in this case, we don't have any corporate data entered, so we can choose to remove those corporate values if we want. And then you can save those as your default preferences for future scenarios as well. We can change the 2-year that we're analyzing for. Right now, we're analyzing as of the final year of the plan, which is helpful to start with, but they may also be interested in what happens if they pass away at age 89 and 87 instead of 100. And so in this case, what's happening is that if we scroll down to the estate, you'll see that the values are much closer together. There's less of a deviation at that point in the plan. It's only once they start to live well into their 90s that there becomes a large difference. So rather than changing the year here, what we can also do is review the data in the form of charts through the Trends tool. And I've already pre-selected to just focus on the estate after tax. So I used the select metrics and I excluded all of the other charts. You can add them back in as you'd like, but I want to focus just on the estate tax for this discussion. You'll see that the base scenario, our first one, has the largest estate in all circumstances because it didn't have any of the additional changes modeled. With scenario 2, 3, and 4, we can see that there's a bit of difference in those outcomes depending on how long they live. So if I remove the base scenario for now, we'll see that the best scenario for them is the move closer without downsizing. But once they start to deplete their financial assets and need to start to borrow, that starts to go sideways quite quickly. So the move closer and plan to downsize is likely more appropriate given that they may live into their 90s. And then the stay in current home and pay for additional support provides them with a higher estate at this section of the life expectancy, but a lower level of resources for the initial period of the plan. So you can have a discussion about when they may expect to pass away, how long is one plan better or worse than the other, whether their primary concerns are their estate or their longevity, and really have a detailed conversation with the client about putting their mind at ease about which option is best for their goals. And if they're all the same, then that can be just as informative as if there was major differences. It can help the client feel like they're not making a major life-altering decision if the circumstances in all three cases are very similar. So now that we've created our chart, we can go to the print option in the top right and create a custom PDF for this section. We can also go back to the summaries table and choose different scenarios to include. So if we go to select different scenarios, I could just focus on scenarios 3 and 4, the most likely paths that the client will take, and then compare the two together to get a sense of what the differences are on each individual metric. And again, I could print this in order to create a custom PDF. So that's been able to help Luke and Mara with one of their questions, which is related to the disability consideration, the caregiving responsibilities. But we could repeat the same process for questions about volatility, helping Han. We can show them what an extra loan to Han would do to their finances. We can show them what would happen if their investment returns were lower than expected or variable instead of static each year. So lots of flexibility in terms of creating scenarios, comparing them, and then helping our clients with their most important questions. Once you're finished with creating kind of a final plan, then you would be able to proceed to the client report. So I'm going to do this in this case for scenario 4. I would go to client report, and then you can customize what charts, tables, and comments you want to include in the final deliverable. So you can go to report builder, select which pages you would like to include. So as an example, I'm going to just do snapshots only, create a nice simple 2-page summary. I'll go to report editor and then review each of those pages. So you'll see we have things like the goal summary of when they're going to retire, how much they're spending. We can add any variables that we want to this page. We can customize text and add custom template variables. And that's one important factor. All of these are referencing specific values. It's not a hard-coded number. If you change the plan, these reports change with it. Going through each of the projections, we can also add comments to any of the pages that we would like. So for instance, with the goal progress, I can enter in a note explaining what this means and what options are available going forward. Continuing on through each of the snapshots, eventually we'll arrive at the recommendation summary. We can enter in one final set of custom text. And then we're ready to review the resulting PDF. So here we have a nice simple summary of our final plan, their goals, the key assumptions, whether they're on or off track, what's happening to their investments over time, their current net worth, how much they're spending, how much they have available, where their money is coming from, the final estate, and then custom text. So we could pair this with any of the comparison PDFs and documents that we've generated along the way in order to provide them with a very customized takeaway based off of our conversations and their needs. Now, we have had to move quite quickly through the software today because this is a more complex client file. We weren't able to answer all of their questions, but we would be able to gradually create those projections and have a very detailed discussion with the client. When you do sign up for your free trial with Snap, you can access our help site immediately by clicking on Help and then Help Center. This will allow you to reach out to our customer success team and get support on a one-on-one basis by phone, email, or screen sharing support. And then you can access all of our previous webinar recordings, articles, and videos to help get the most out of the software. With that, I'm going to pass it back over to Alex. We'll open it up for questions and walk through a few next steps.
Wow, Steve, thank you so much. Yes, as you just said, we have covered a lot this hour, but we are here to address any and all questions you have in just a moment. If you do have any questions that you would like to see answered during our Q&A session, now is the time to get them in. Just send them in to me through your question tab. So it is time to take a pause for our second poll question for your CE credit. I am launching that now. That will pop up on your screen. Who had a workplace accident that impacted their ability to work? Was it Luke? Was it Mara? Or was there no workplace accident whatsoever during this case? Wonderful. I can see those answers coming in. I'll give you a few more seconds here. Hopefully we can get them all in. And I'll give you about 5 more seconds here. 5, 4, 3, 2, 1. And we are closing the poll. Thank you so much, everyone. Okay, perfect. So a few more notes here before we get to our Q&A session, as well as the third poll question. You saw at the beginning today that we have a special offer for those of you here with us today who are not already using Snap Projections. This is a new offer, and we are really excited to offer something different after taking in advisor feedback and suggestions. So rather than make a draw for a single winner, we are going to give something to every single advisor who signs up for a free trial today. Each of you who starts before midnight Eastern time today will receive an extended 1-hour onboarding and training session. Plus, we will set up your report branding for you, and we will help you to create and save your own personalized snapshot template, just as you saw Steve do here today. Now, the snapshot is fairly new, and I know Steve had to cover it quite quickly. It's a very flexible, short, condensed report, and it's most often used in 3 ways, according to our advisors. It can be used as a standalone client deliverable that essentially replaces your longer client report. It can be used as a 1 to 2 page quarterly or annual review, and it is used as the executive summary to the full comprehensive report. The beautiful thing about this is that once your template is created, your snapshot is automatically built from the data within your projections. No extra work is required to produce this report. As part of this special package today, the support team will work with you one-on-one to create your template so you can instantly pull a 1 or 2 page report from your projections. So to start your free trial and take advantage of this special offer, you're going to go to snapprojections.com. You can scan the QR code there on your phone to get to this page, or you can click over to the website. I'm going to drop the link to get here in the chat right now, and I will send this via email. On our pricing page, you'll see there are 2 plans for you to choose from as an independent advisor. Advisor Business is the plan you want for the corporate module. You are free to upgrade, downgrade anytime. So wherever you want to start today is fine, and you're free to make changes as needed. And to our current users, we have, of course, not forgotten about you. Thank you for being here today and for being an active member of the Snap community. Remember to you folks that you can be earning free months of Snap when you send referrals our way. This program is win-win. A referred advisor gets 50% off their first month of Snap, and you get an entire free month of service if the advisor you sent our way becomes a paying user. There is no limit on how many times you can do this. We have created a new referrals page that you can access from within your Snap account to make it even easier to leverage this program. So my last item today before we move on to your Q&A is going to be our last poll question, and hopefully I have made this an easy one that is popping up on your screen right now. Do Luke and Mara have life insurance? I'll give you a few more seconds to get those answers in. And again, the case study is down in the handouts tab. I'm sure you all have that by now. And if you've answered the poll, please be sure you are sending in our questions because we are just about to move on to the Q&A session. So I'll give you about 5 more seconds here, and then we've got to close this poll and move on to our questions. Okay, there we go. Thank you everyone for answering. All right, so we've got a good number of questions that are rolling in. So let's just try to run through as many as we can quickly, Steve, because I see we are already, we've got just 5 minutes left here. So number one, this is a data entry clarification question. The question is, am I missing something? Luke can contribute to a spousal plan in his name. Isn't Mara contributing into her own RRSP with her limit?
Yeah, great question. So within SNAP, the spousal RSP is actually quite unique. It has two separate contribution columns. The client themselves can contribute into the spousal RSP in their own name, and that would be this contribution column here. That is going to reduce the client's contribution room and their taxable income. In this case, I'm making a spousal contribution into Luke's account in Mara's name. So this one is reducing Mara's contribution room and reducing her taxable income. So you have that flexibility within SNAP to model either situation.
Perfect, thank you. Okay, next question. How can we model a reverse mortgage?
Yeah, so if we go back to scenario 2, where we chose not to downsize, we see that there's a shortfall starting at age 83. So we could go into scenario setup and then debts in order to add a reverse mortgage. So it's just going to be a new debt item with a $0 balance, the expected interest rate on the loan, and then we can set this to interest-only payments. And what this would allow us to do on the planning page is for any future year, we can start to borrow against that reverse mortgage either in a lump sum or on an annual basis. So I've now created a new debt page for a reverse mortgage. And if I go to the year where they start to have a cash flow issue, I could borrow, say, $100,000 and copy that down for, say, a 10-year period. So I could do that until age 92. And so that's going to borrow 100,000 each year, and it's going to build up the balance owing once I run the scenario and it calculates everything. So that's how you can create a reverse mortgage, is by adding a new debt and then using the planning page to model in any borrowing so that SNAP can show the total amount owed and then factor that into the final estate calculation.
Perfect, thank you, Steve. Next question, how do you model long-term care costs?
Yeah, so we kind of showed it with the additional support, the rural support expense, but you would come into additional expenses, add in care costs, enter in the expected annual amount, so maybe it's 60,000 a year, and then we can indicate at what age that would start. So if they want to cover that starting from age 80 onwards, then we can enter that as an additional expense with customizable settings, whether you want it indexed or not. And then that would show up on the planning page and be factored into their required cash flow for each of those future years.
Perfect, thank you, Steve. And yeah, so a few more questions here. I'm just going to try to cover one more quickly. If we wanted to include a client's joint life annuity, annual income payments, how would we do that?
Yeah, so we would do that from this scenario setup, and then incomes, you can enter in the annuity payout and then enter in the annual amount, whether that's individual, joint. You can indicate whether it's taxable or not. If there's some that's taxable and some that's not, you can break it out into two separate income items, but you would enter that under the income section and then have flexibility about when it starts, when it stops, and any of the tax settings.
Perfect. Thank you so much. Okay, we are on the hour, so we are going to have to wrap it up here to be respectful of everybody's time. If your question has not been answered live, I will follow up with you via email, so you will get the answers you are looking for. Thank you so much, everyone, for being here with us today, and I hope this has been a valuable use of your time. Enjoy the rest of your day, and we will be sending out a few follow-up emails, so I'm looking forward to connecting further with all of you. Thank you so much. Bye for now.